Are you a real estate investor considering buying student rental? Do you have any kids that are currently in university and college, and you are constantly shocked at how expensive it is to rent a place at university, at the residence, and how much you are going to be paying when you are finding student rentals? And are you wondering if there are better ways to finance a kid's university or college education by buying them a property for them to live in? Well, if that's the case, this is the video for you. We're going to dive deep into the tax benefit of 3 common structures that parents are using to own a student rental for their kids to live in while they are in college or university. But before I get started, make sure that you give us a thumbs up if you find this video useful. With that, let's get started. So now that you've decided to purchase a property for your kids to while they are in university or college, what is the best structure that you could minimize the tax, or in terms of financing and other tax incentives that are available? Now, the first option that you can choose to own this particular student rental for your kids to live in is to have your kids own it directly in their name, assuming that they're over the age of 18. Obviously, you have to reach the legal age of 18 before you can sign off on any legal documents. So the way it works is that you could potentially gift a portion of the down payment to your kids, and your kids can then turn around and get financing on their own with the bank. And the bank may or may not be able to grant the mortgage to your kids because they don't have a long history of job and credit history. So you may actually do have to go on title when it comes down to purchasing the student rental. Now, before I dive too deep into the financing portion, let's evaluate each option based on certain criteria. Now, first option is to buy your property in the kid's name, and the first thing that the benefit of it is the tax incentives that are available. So now that your kids are going to move into this property, that means your kids would be able to use the first-time home buyer tax credit, which is about $1,500 tax dollars in the kid's tax return that he or she is eligible to claim back. The kid would also be exempted or get a first-time home buyer land transfer tax credit that they could use to apply against the land transfer tax on the closing of the property. So that's the second incentives. There are some other incentives that are not as likely to be utilized, including borrowing against the RSP from the home buyer's plan within the RSP. So the kid would be eligible to borrow up to about $35,000 from the RSP if they have ever made contribution for $35,000. If you're buying the student rentals in the kid's name and they are just going to university, chances are they don't have enough RSP contribution room available. So it's less likely for the kid to be able to utilize the home buyer's plan. The last thing that could potentially that's coming in the pipeline is the tax-free home saving account. That's coming in the pipeline in 2023. Each individual will be eligible to contribute up to $8,000 annually, and you can take it out tax-free. But you can also get a tax deduction against their income. So there are tons and tons of tax incentives available for people who are purchasing for their own personal use of the property. So first thing, tax incentives. If you buy it in your kid's name, excellent, lots of tax incentives available that you can take advantage of. Second thing is about the rental income and expense. So depending on what you're planning to do with that particular property, a lot of the parents that we work with, they are planning to rent out the property, the rest of the property. It could be the kid using really one room out of the 6 rooms available, or it could be 1 room out of the 5 rooms available. The other 4 rooms are all rented. So the kid really just used 20% of the house, and the remaining tenants would be using the 80% of the house. So in that particular situation, the 80% of the rental income that you receive from the 80% of the house would have to be reported by the kid on the kid's individual personal tax return. And the income has to be all reported. And then the kid would also incur expenses on the house, such as mortgage interest, property tax, insurance, and utilities or internet expense. And the adult child would only be eligible to claim up to 80% to offset against the rental property, because the 20% is considered personal use by him or her. So rental income and expenses, it's going to be reported by the adult child because the adult child is now the owner of the property. So you could only deduct up to whatever percentage that you are renting out. The kid would also have to report the rental income. Now, capital gain on sale. When the kid sells the property, it's no longer you as a parent that's selling the property. When the kid is selling the property, the capital gain realized on the sale of the property is taxable, assuming the primary residence exemption does not apply. Now, in my previous example, the adult child only lives in 20% of the house. The 80% of the house was rented to her friends or any other roommates. So when the property is sold at the end of the university years, the adult child would be responsible to report 80% of the capital gain realized from the sale of the property. The other 20%, she has to report it, but she could also claim primary residence exemption on that 20% of the property. So if the house incurred about $100,000 capital gain, $80,000 would be taxable because 80% of the property was used as rental. $80,000 is reported on the personal income tax return, and out of the $80,000, only 50% of that is taxable at this moment, so only $40,000 would be taxable and added to the kid's income. Now, the benefit of that is that presumably, when the property is sold, the adult child would just be at the beginning of their career. So they are presumably they're not making nearly as much money as the parents would be, and therefore it is more beneficial for the kids to report the disposal and the capital gain as well. And then the kid would also be eligible to claim primary residence, to share at least that portion of the primary residence that he or she lives in. So you could potentially save a lot of money in terms of the capital gain tax. Now, financing. We talked a little bit about financing earlier. When a child turn adult at the age of 18, chances are he or she doesn't have a long history of employment, and he or she doesn't have any credit to begin with. So it would be challenging for a young adult to be able to qualify for financing. And typically, from what I've seen in the marketplace, mortgage professionals or banks would typically require the parents to either go on title with the adult child, or the bank would require the parents to guarantee the loan, guarantee the mortgage. So either way, depending on what's the requirement imposed by the bank, there could be further tax implication, especially those of you who decide to go on title with the kids, but with the intention that the property is given to the kid and the kid would own 100%. So those require further investigation and more work to be done, more administrative work to be done, and probably more filing later on with respect to the ownership or beneficial ownership that you are intending to own. So make sure you speak to a professional real estate accountant if you are going on title with your kid, just so that the kid would be able to qualify for financing. Now, the last criteria for evaluation is the control. So as we all know, now the kid, under this particular option, the kid is the true owner of the property. The kid reports the income and expenses, report the capital gain on sale of the property, has the responsibility to pay for the mortgages, and has the responsibility to collect rent. All these things are all being done in the kid's name. So it's no longer in the parent's name. For those parents out there who are concerned about losing control of this particular property, well, you should be concerned under this particular scenario, because you practically gift the down payment to your kid and you do not have anything in control. So legally, you are not eligible to put anything against this particular property. If the kids decide to run it off and sell the property and pocket all the cash and then run off to do something else, that's totally legal. So if you're concerned about losing control of this particular property and investment, this is probably not the best option available. Okay, now that we cover the first option, the second option is to purchase the property, the student rental, directly in the parent's name. And why is it even an option? Well, it is considered an option. It's simply because the control. When the parents invest in their own name or invest in their corporation's name, the parents have full control over the property. The parents are responsible to collect rent, pay for the mortgages. They would be responsible for paying for the mortgage in option 1 when the property is purchased under the kid's name anyway, because chances are the bank would require them to pay to guarantee for the loan. But under the second option, when the property is purchased in the parent's name or parent's corporation's name, anything within the parent's ownership, there is no tax incentives available, unfortunately, because now all the tax incentives that we mentioned earlier that are available for first-time home buyers, such as the first-time home buyer tax credit, the land transfer tax credit, and then potentially borrowing against the kids' RRSP, as well as potentially using the first-time tax-free home saving account. Those are not available at all because chances are the parents are not eligible, they're not considered first-time home buyer anymore. And therefore, there is no longer any tax incentive for the kids for if you were to purchase the property in the parent's name. Now, in terms of rental income and expenses, it gets a little bit more complicated. Obviously, the parents would have to report all the rental income, all the expenses. Now, let's just continue with the previous example that I mentioned. The kid lives in use 20%, has 5 bedroom in this student rental. The kid use 1 bedroom and share the remaining common area with the other 4 tenants. And so the kid essentially used 20% of the house, and the arm's length tenants are using the other 80% of the house. So the parents, like under the previous scenario, when the kids are the owner, now the parents are the owner. Now the parents are responsible to report 80%, report the income from renting out 80% of the home. And the parents would also be eligible to claim 80% of the expenses against earning the income. Now, in terms of the other 20% of the expenses, depending on whether there is a rental agreement happen between the parents and the kids, and if there is no rental agreement, the parents would not be eligible to claim any of the rental expenses because there is no income coming in. So in my example, you can report all the rental income from renting out the 4 rooms to the arm's length tenants and deduct the 80% expenses, but then you have to back out the 20% of the expenses because it's considered personal use, that the remaining 20%. Now, if the parents own this particular property in a corporation, it gets way more complicated. Because if the kids are not paying the rent to the corporation, no longer the parents directly, we're talking about a corporation owned by the parents. If the kids are not paying for the rent, then there is a shareholder benefit because the kids and the parents are related, so then there is this complicated thing called shareholder benefit. The kids would then have to report the income or shareholder benefit on his or her personal tax return. It gets way too complicated. So the key though is to have the kids pay a fair market value amount of rent to the corporation, and the corporation would then be eligible to claim 100% of the expenses of the house, but also report 100% of the income, rental income collected. So that's an option. Now, another thing that we need to pay attention to when we claim rent, when we receive rent from related parties, any losses incur on the 20% of, in our example, it was 20% personal use. If the parents were to receive rent and the rent from the kid is not enough to cover the expenses incurred on that 20% share of the property, any losses incurred would be denied because the whole situation is arm's length, so you're related to your kid, and therefore the losses incurred on renting out that portion of the house would be denied because you're arm's length. So it gets a little bit complicated. Now, capital gain on sale. Similar to what I mentioned in the past, capital gain on sale of the student rental would have to be 100% reported by the income by the parents' personal income tax return if the parents are the owner. If the parents own this property through a corporation, then the corporation would be responsible to report all the capital gain on the sale of the property. There is no primary residence exemption whatsoever because it's a pure investment property. So the 100% of the capital gain would be taxable. Next is financing. So we mentioned earlier under scenario number 1 that when the kids own the property, financing, typically the bank would require the parents to guarantee the loan, and therefore the parents are still on the hook to pay for the mortgage. And under the scenario number 2, when the parents are the one that's owning the property, or the parents' corporation own the property, obviously the parents would be on the hook for the mortgages. But sometimes the bank would offer these second home type of product, second home mortgage type of product, which allows the parents to borrow a lot easier compared to a straight rental, straight investment property. It would allow the parents to borrow, have that mortgage a lot easier. The process would be a lot smoother because it's considered a second home. So it may be a good thing for parents who are considering buying the home for their kids to live in. Now, last but not least, to some people, control is very important. So for parents who think control is important, having the property directly registered under their name is almost a slam dunk. There is no reason why, if you think control is the most important thing in your situation, there's no reason why you would put the name, your kid's name as on title for this particular, when it comes down to buying student rental for investment. Okay, the last option available for parents to purchase student rentals, it could be via something called a family trust. Essentially, it's a family trust that's set up just to own the property or own a corporation that in turns own the property underneath. The purpose of setting this up is mainly because of something called control. So if your parents who really want absolute control over everything, then family trust is the way to go. But the downside of having family trust is often the setup cost and the annual filing obligation. There is also a 21-year expiry date for family trust. So at the end of the 21 year, you would have to decide what you want to do with the asset within the corporation, or otherwise deemed disposition would be triggered, and you have to pay highest marginal tax rate within the family trust, which sucks. You would try to avoid that. Now, so if you were to purchase a property under a family trust, the tax incentives similar to buying it in the parent's name are no longer available. Generally speaking, they are no longer available. All these first-time home buyer saving tax credit or borrowing against your first-time home saving account and all these first-time this, first-time that, no longer available. Now, the rental income and expenses would then be reported by the family trust. And if there is any net income available, it has to be distributed back to the beneficiaries. And depending on who the beneficiaries are, there could be a small chance that if it's reporting a positive number, tax on split income rule could apply, which means that the beneficiary would be taxed on 100% of the net income that's being distributed to the beneficiary, and it's being taxed at the highest marginal tax rate. Not good. But typically speaking, it's unlikely the property would be generating net rental income or any substantial amount of rental income anyway. The same scenario apply for anything that's rental, and only that portion that's related to the rental would be tax deductible. So only the portion that's of expenses that's related to earning the rental income would be tax deductible. In my previous example, 80% of the property is rented out, so 80% of the expenses would be deducted against all the rental income coming in, and the net amount would then be distributed to the beneficiary. In this case, likely it would be the kids. Now, capital gain on sale of the property. Now, this one is huge. The reason why you want to keep control and also have to also take advantage of some of the benefit of owning the property for your kid is this capital gain distribution. Essentially, you would then be able to distribute the capital gain to the beneficiary which in this case would be the kids, and have the kids report the capital gain without having it attributed back to you. So, and the kids would be eligible to use the low marginal tax rate and pay the least amount of capital gain tax on the sale of the property. So it will be pretty awesome to be able to apply that low marginal tax rate on the sale of the property. Now, financing is something a little bit iffy in my opinion. A lot of mortgage brokers out there are not as familiar with family trust as compared to applying for a mortgage directly in the personal name. So a lot of the mortgage broker and even bankers would not be able to handle the financing for you if you are purchasing the property directly in the family trust. So you got to take that into consideration when it comes down to purchasing the property. And finally, control, as we mentioned earlier, you have the ultimate control when you set up a family trust. You can choose to distribute the rental income to one kid, not another. You can also choose to pay capital gain to one kid, not another. So there's quite a bit of flexibility when it comes down to family trust. And if you are the one that's looking for flexibility, an ultimate way to split income, family trust could be the way to go. But because of how complicated family trust could be and the tax rules surrounding family trust is so strict, it is important that you work with a specialized real estate accountant on this type of arrangement, so then you're not stepping over any rules and you would not trigger any negative tax implication. Now that we've covered the 3 common structures used to own student rentals when your kids are moving in, if you learn anything, make sure that you give us a thumbs up and leave a comment in the section below. If you have trouble figuring out how to own a student rentals for your kids to live in, you're welcome to reach out to our office as well. You can contact us. The contact information is in the comment section in the description below. If you like our video and find it useful, make sure that you share with your friends. Until next time.